We've all got a budget to work with and do our best to hit our portfolio goals. But sometimes it's the smallest movement in price that can make a massive difference in the growth of your portfolio. In this episode, I'm going to talk to you about how an increase of $50,000 to $100,000 could take away so many limiting options. And you might be surprised how little it changes your deposit by, but how much it can lower your time to buy and potentially increase your gains in the market. I'm Junge Ma, Lead Research Analyst at InvestorKit. Let's get into it. Naturally, we all like to stick to a low budget. It might be because we don't have much savings, we don't have as high borrowing capacity. It could be because we like good yield, making holding a property easier in this high interest rate environment. Or we just don't like debt. Lower budget, lower debt, especially if it's the first investment property we're gonna buy. Or sometimes low prices seem like a deal, seem like we're buying something undervalued, especially for someone living in Sydney where the median house price is 1.4 million. When we see the 190,000 median price in Broken Hill, naturally we would think that's a bargain to buy a house for that little amount of money. But it might not be the best idea to always stick to a low budget. Here are 3 reasons I'm going to show you. Let's start with the limited market options. Now that the national median house price has increased to $905,000, 80% of SA3 regions across Australia have seen their median house price exceeding 600,000. In a bucket of lower than 500,000, we still have 51 SA3s out of 330. 51 doesn't sound bad, but the reality is a lot of them are actually either remote or rural areas that do not have a sizable or reliable property market. Here are some examples. Barkly in the Northern Territory. It's a vast SA3, but there are only 1,200 houses in the whole SA3. Broken Hill, median house price is just 190,000, but the local economy is not diverse enough and the population is actually declining. East Pilbara in WA, the economy is mining dominated. Close to half of the people living there are employed in the mining industry. While seemingly we have 51 regions to choose from, the reality is we may just have 20 to 30 markets available to choose from. So if you really don't have the savings or borrowing capacity to go for a higher budget, there's still decent market to buy in, for example, Mildura, Shepparton, Mount Gambier or Burnie. But if you have the capacity to just slightly increase your budget, you'll be immediately enjoying more market options. By increasing 50,000, you'll be having 21 extra markets, and by increasing another 50,000, you'll be having 16 more markets to choose from. And then if it's possible to increase your budget to up to 650,000, there'll be another 19 regions to choose from. And you know what? To increase 50,000 of budget, you don't actually need an extra $50,000 at hand. Here's an example. We just assume that you want to increase your budget by 100,000 from 500,000 to 600,000. These 2 tables are going to show you what's actually changing. For anyone who's listening to this on iTunes or Spotify, head to our YouTube channel to actually check these tables. So, while you increasing your budget from 500K to 600K, your deposit, let's assume that we're using 90% LVR loan, your deposit will be increasing by 10,000. Your stamp duty will be increasing by around 4,000 because that's 4% of the total property value. But aside from these 2 items, your other costs are actually staying the same. For example, building pest inspection, they're still for just one house, so they'll stay the same. Your conveyancing fee would be staying the same because that's just one purchase. And your insurance premium won't increase much because the property won't change significantly. Your building insurance premium will be changing, but in a very unnoticeable way. So in total, to increase your budget by 100,000, the actual increase you need will be just around 14,000. And again, if you have the extra cash and have the extra borrowing capacity, it's worth considering increasing your budget, because by increasing that, you find yourself in a much better position in finding a property that you like in a shorter amount of time. And second, low price doesn't necessarily mean better deals. I'll give you 2 examples here. One, Broken Hill. As I mentioned before, in Broken Hill, the median house price is just $190,000. For a lot of people, that's a great deal. But what you're actually entering is a not as healthy market. The local economy is more reliant on mining than usual. 31% of the economic output is from the mining industry. Fun fact, this is what I learned just last year. One of the world's largest mining companies, BHP, it actually stands for Broken Hill Proprietary Limited, because that's where the company started. Population is not growing healthily. In fact, over the past 5 years, the population declined by 6% compared to many other cities where population is growing healthily, increasing their housing demand. And then if you go to any real estate platform, just check the properties in Broken Hill, you see a lot of properties are actually not in their best condition. So while Broken Hill has lower price, it might not be the best place to invest in. And then another example is West Tamworth, a suburb in Tamworth, the regional New South Wales city. It's quite centric. The median house price there is $380,000, much lower than the surrounding suburbs. It might seem like a great deal, but it's cheap for a reason. If we check the public housing percentage in Tamworth, you see that in West Tamworth, public housing represents 16% of the total housing stock, much higher than the surrounding suburbs. In fact, I heard even local people would avoid that area because how not safe it is. So while the price points are lower in West Tamworth, you might be facing higher insurance premium and very similar property management fees, if not higher. What I'm saying, if not higher, that's because for some property managers, managing a low rental income property might not be worth it, so they may want to increase their rate to make it profitable. But again, these rates, they vary from city to city, from suburb to suburb, so you may need to do your due diligence. 3, higher yield may not necessarily be better. I'll explain this from 2 angles. One, it is important to consider your investment return holistically. For example, Broken Hill again, the rental yield there is extremely high, 9% plus. But because of the imbalanced local economy and likely the poor livability, its long-term growth hasn't been as good as other regional New South Wales towns. And then we have far north Queensland. For example, Townsville, the gross yield there looks really good, but if you consider the high insurance premium, the high maintenance cost because of the high cost of labor, and the high council fees, the net rental yield is actually just average, very similar to the other parts of the country. So the gross rental yield level is not always the most important thing you should be looking at. And the second angle would be your yield on purchase. As long as the rental market pressure is high, you will be expecting healthy rental growth. So over time, even if your yield at purchase wasn't as ideal, over time, your rental yield will be becoming better and better. That is why when we choose locations, we always want to check rental market pressure as well. We want to see low vacancy rate to make sure that demand is high relative to supply. We want to see healthy job market and low unemployment rate to make sure that overall the housing demand is high in that area. And then we also want to see low building approval rate to make sure that there's no large amount of new housing coming into the market to loosen your rental market. Budget is a very personal thing. If you have limited cash and limited borrowing capacity, there's no problem to stay with the low budget. But if you have the capacity to do it, it might be a good idea to consider increasing your budget, to increase your market options, to potentially get into a market with better growth potential and easier to hold. So to summarize, budget is actually a very personal thing. If you really don't have the extra cash or borrowing capacity, it's no problem to stay with a low budget. But if you do have the capacity to increase your budget, I hope what I've explained today has really illustrated the benefits in increasing the budget strategically when possible. If you have any questions, leave your comment below. We'd love to hear your thoughts on this one. I'm Junge Ma, the Lead Research Analyst at InvestorKit. I'll see you next time.